What's up? What's up, YouTube? Great heavens. Everything is looking good. Everything is fine. Lots of stuff today. I have a lot of stuff, as you can see. I don't know how much we're actually going to cover. However, let me respond. Some investing guys live. Crazy. We are farmers. Bum, 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 bum. You're going over there. All right. We're doing stuff. First of all, what is happening? Intel's up 6%. What is happening? Why are we up 6%? 6%? I'm making so much money. Does he know what is happening? Is there something? No news. Intel's up 6% on no news. What about everybody else? FRDM's up 2%. Obviously, everybody went to go buy FRDM because of my video. Obviously. So that's why. MJ's up 2. Corsair's up 2. Beyond Meat's up 4.5. Amazing. Not even 90 cents. Not even $1. Wow. Nvidia's up 3%. Good lord. Google's up 2. Apple's up 2. Amazon's up 2. Man. Yo, Netflix is down 15 on the month. I guess that sort of makes sense. They're going out. They're buying. They're trying to make that big acquisition. What happens when you try and acquire companies is you lose a lot of money doing it. Yo, Pinterest is break even now. Crazy. Congratulations to all my Pinterest shareholders. There aren't many of you. That's for sure. $91 UK purchases 700,000 shares of Pinterest. What's institutional ownership look like on Pinterest anyway? Pins. Pinterest. Benjamin Silberman. Is that the Is that one of the founders? co-founder and executive chairman of Pinterest. And then Paul is his name Sciarra? Paul Cahill Sciarra. He's the other founder. So I remember reading a long time ago when I was doing research for my Pinterest video. There was a Harvard review about founders that were going public, and they were talking about Pinterest and how Pinterest was one of the sort of new companies, these new age companies that were going public with dual class structures. So there is two classes of shares, and one class of shares which holds like 10x voting power, then all the other shares are given to the founders, so the founders always retain control. Which is an interesting structure. I think the same thing generally happens with Google. The Sergey Brin owns like a majority of voting shares still. And so Google can sort of like move. It gives the ability for companies to sort of move very quickly because it's just like the founder guy. You don't have to go through the whole like corporate bureaucracy of like, oh, well, we have to go and we have to get approval from the shareholders. It's like, well, shareholders are obviously a consideration, but at the end of the day, the primary shareholder is the guy who has all the voting shares. Pinterest has 4,000 employees. What are they doing all day? Inflection Point Investments. Norges. Bailey Gifford. Wow. 91 UK. Takes a 1% stake in the company. When was this? 1 day ago. They bought 1% of the whole thing. Wow. How much is that? 700,000 shares at $26. 14 million? No. That'd be 140 million. That'd be 170 million. Impressive. Where'd it go? I just saw it. 91. $238 million. Wow. That's a lot. So Intel's up 6% on no news. I wonder what's going on there. I think I hit my break even on shares. Let me see what my average share price is. It would be very funny if I'm at my break even here. Intel's up 6% trading. No, I don't want that. Nope, I'm still down 4.5%. It needs to go up another 7 or 8%. My average share price is $41.20. It's $41.20, almost $40.20. Wow. Man. Everybody all of a sudden realized that NVIDIA invested in the company, so now everyone wants a piece. There doesn't seem to be gigantic news happening today. NVIDIA's one of the most active, of course. Top gainers. I don't think that this is the top losers. Gonna be honest, doesn't look like it. Klaviyo, wow. It's been a while since I remember like relentlessly mocking Klaviyo when they went public because of how stupid it was. Can I get a IR? Let's see how well the business has done since they went public, which was 2 years ago, I think. Klaviyo is basically like I think it's an email marketing thing. $300 million in revenue, and they're trading. Wait, how much was that? KVYO. They're trading at $9 billion, so they're already 30 times the revenue. That seems good. The presentation. We are the first AI. We are the AI first B2C CRM. Be yourself at internet scale. Okay. Very well. 13 years of innovation. They gained $100 billion in TAM. Wow. KI. Wow. Very reminiscent of another short I made. 183,000 customers. Okay, can I get like a see, this is what's always really funny. Is there like more than half of the presentation is like, look at how cool of a product we have, guys. And then the sort of at the bottom, they're like, okay, here's all the numbers. Revenue growth is very quick still. So 54% and then 35, 33. So slowing slightly. I mean, it looks good though. 17%. You'll love to see 17% customer growth with 34% revenue growth. And then 36% is them bumping existing customers into higher brackets of charging for more. A classic. Strong free cash flow. 167 million. I mean, yeah, I guess. Um, 50% cash flow margin actually. Bueno, 15. Wait, when? Oh, this is quarterly. 15% free cash flow margin. Honestly, not bad. They have 76% margin on everything else, which is wild. This is a screenshot, I think, which is crazy. Anyway, Klaviyo still. I mean, they're growing quickly. You just gotta pay 30 times revenue. What is EverCommerce? What do these guys do? Software that powers the service economy. Amazing. We're building a world-class scalable organization that's driving digital transformation across multiple industries in the service economy. It's another CRM. Wow. Anyway. Those are our biggest losers. Let's look at our biggest gainers. Baidu. Why is Baidu in the news? SanDisk up another 10%. Oh man. What's happening with Baidu? Ugh. Okay. They have a chip making arm. Shocker. Genuinely, maybe one of the things I regret the most is missing SanDisk. Like right here at $32 a share. Because I looked at SanDisk in the middle of like April and May, and I was like, man, this is a good company, right? Like this is solid. These guys have growing revenue. They have strong profit. I just missed it. It's tough. Lost 1,000%. Why is CoreWeave up? CoreWeave doesn't even do anything. Man, we really are. Yo, Intel's up 8%. What's happening? Tax loss harvesting is over. It's time for everybody to buy. I guess we're going back into stocks only go up mode. Hut 8 Mining Corp. Man. NuScale Power. Headlines that just don't make sense, by the way. They're buying Google. Spoiler. Treasuries gain. Treasuries don't look like they're gaining much. Oh yeah, all the year-to-dates reset now. It's very funny. It's so crazy to see a bond fund lose 49% of its value. It truly is a mystery. Kind of spooky times, I think. Even in 2010. I mean, yeah, it took a while for it to recover, but like, good lord. Oh, 2016 to 2019, that's like 2.5 years. It's been 4 years. I remember I started buying TLC and BND. These guys have had relatively good performance. But like I remember I started buying TLT and BND because I was like, the Fed is gonna pivot. They're gonna start cutting rates, and then they didn't cut rates for 2 whole years. They just decided to wait. Caesars. Like Caesar's Palace? Oh yeah. Wow. It's down it's down a little more than 30%. You know what? Let's take a look. What do these guys do? Like, I get sort of what they do, but what do they do? Click here for the latest presentation. Are they getting into sports betting? Investor presentation, October 28th, so not that long ago. Third quarter review. Caesars owns and operates a world-class portfolio of over 50 brick-and-mortar locations across North America. Dude, they own literally everything. Caesar's Palace, the Flamingo, the Horseshoe, Paris. This is crazy. Good for them, though. Adjusted EBITDA distribution, excluding corporate and other. So they own $2 billion in properties, and they lease another 1.7. Caesar's digital platform extends across 33 North American jurisdictions. What does that mean? Oh, online sports betting. I was right. Yeah, so they own. This is crazy. They just own all of them. Portfolio of 8 major casino resorts, 6 owned, 2 leased, including the iconic Caesars Palace, Las Vegas. Gordon Ramsay Burger. Amazing. This gives me Vail Resorts vibes. This gives me Vail Resorts vibes. That, like, sure, you own a lot of good assets, including you own, like, genuinely some of the best assets in the entirety of the casino and gambling world. But, like, does that actually translate to revenue growth long term? That's kind of interesting, though. Sports betting hold rate is 7%. Huh. Okay. So they have they have a lot of debt, but it's not due for a while. And they can likely get it they can likely restructure that debt later on. Caesars has repurchased 6% of shares outstanding, totaling $400 million in a year. Okay. So they have a lot of cash. Net revenues up 0.1%. Yikes. Adjusted EBITDA is down 11%. What does that mean? What does hold adjusted mean? Okay, I just don't understand any of this, which is not great. Net revenues and digital stuff is up 3%. iGaming handle, man. Sports gaming. ARPMUP. So in 2 years, they've gone up these revenues in this iGaming thing have gone up 140%, which is only $124 million of, I don't know what their total revenue is, but net revenues. So iGaming has grown to 5% of their total revenue. Well, actually, it grew a lot in the first year. It grew, 52 million to 96, and then it's only gone from 96 to 124, which 30% is still pretty impressive, but not nearly as impressive as like 90%. Net revenues, it's just not great. Yeah, I don't know why Oklahoma. Yeah, they sure do own a lot of stuff. Where did I see that? Let's read through this. See what's going on. Pennsylvania-based Quaker Capital Investments added 280,000 shares of Caesars Entertainment in the third quarter. The overall change in position from the previous period was $6.46 million. They own 1 million shares, valued at $30 million. It's not even in its top 5. It's like number 6. So revenue is $11 billion. Oh wait, has it really gone up like a lot recently? It kind of has. Really bad earning. Yeah, but it bounced off of earnings, which isn't real. This is not at all what I asked for. Thanks. Oh. What a tragedy. Caesars Entertainment, not amazing, I think. I don't like this. Let's see if CNBC can tell me what's happening. Did you see NBC is changing their logo? NBC's changing their logo. Weird. Yo, all right, well that's a story. Oh man, I should have. Yeah, RH sub. Yo, that's only 6%. I should look into Restoration Hardware. Kunlinchin. SanDisk. Still upset I missed the boat on that one, but it's all right. Tesla reports 418,227 deliveries for the fourth quarter, down 16%. The electric vehicle maker faces steep competition across the globe from companies like BYD, Kia, Hyundai, and Volkswagen. In the U.S., a $7,500 federal government incentive for EVs came to an end on September 30th. Shares climbed 1% after the numbers were released. Amazing. They're overproducing and underselling. They expected 426,000 deliveries for the quarter, but missed it by about 8,000. Tesla's full-year deliveries fell 9%. Second straight annual decline. Tesla's got to figure out how to sell other things before, yo, that's such a steep decline. It will report its full year. It's so crazy. Here's a company that ostensibly, I love talking about Tesla. It's my favorite thing to talk about. Here's a company that just isn't doing well. They're seeing sales consistently decline. Not overall sales, but like automotive sales certainly decline year over year. And the stock is up 200%. One year chart, up 18%. Okay, so it struggled a little bit. It's such a crazy. I just don't get it. Anyway, down 16%. Tesla's not doing great. I would imagine that Wayfair is doing pretty well today. Up 4%. Not bad. The tariffs. We're no longer doing tariffs, guys. We're no longer doing tariffs. That's actually pretty impressive. Company was down 91%. Now it's up 300%. It's pretty good. Good for them. Adobe's down 3. Interesting. Four-dimensional therapeutics just can't. It just can't. You know. Just can't perform well. Still 750. I want to look at the dogs. The dogs. If you don't know, the dogs. If you don't know what the dogs are, they are the worst performing stocks over the last year. Good. They're the worst performing stocks over the last year. 2025, dogs of the Dow. This is the Dow Jones Industrial Average. It's the Dow Jones Industrial Average. This is the 30 stocks that that define the American economy, supposedly, as defined by the Dow Jones Industrial Index. In it, you have some pretty famous companies: United Healthcare, Honeywell, Home Depot, McDonald's, Merck, Coke, Amgen, 3M, Johnson & Johnson, and you also have Amazon in here, I believe. You have Microsoft in there, obviously. Apple, Amazon, yeah. It's becoming a tech index, really. But, so these are the worst performing stocks over the last year. You've United Healthcare. United Healthcare had a really rough year because, well, they had to find a new CEO for reasons. And then it turns out United Healthcare was kind of like doing a lot of fraud by a different name. They were kind of doing. I'm not really 100% sure what was going on there. But United Healthcare was basically billing things incorrectly, and they were overbilling, and they got caught doing that, and so they lost a significant amount of their share price because of this investigation. Again, I'm not super familiar with the story. All I know is I'm avoiding United Healthcare because, yeah, that's kind of a dangerous stock to buy, I think. Salesforce is an interesting one, down 20%. This is CRM. We're going to look at this in a second. It's a $200 billion market cap company, which is impressive. Down 60%. Again, it rose a lot. Down another 40%. It does CRM software. This is customer relationship management software. I'm somewhat familiar. I've used Salesforce in the past. And I think they make a decent product. It's easy to use, but they've performed quite well over the last while. Their PE ratio is 34%, so I'm very interested. I'm very interested to see Salesforce and their financials. That's for sure. But you also have Nike, Procter & Gamble, Honeywell, and Home Depot all down 10 to 20%-ish. Verizon is mostly flat. Disney's mostly flat. Chevron's up 4. Sherwin-Williams, SHW. I remember. Well, that's great. Sherwin-Williams is such a fascinating company because their paint is so expensive. Like I get it. It's the best in the industry. And like if you're going to yeah, I get it. If it's the best in the industry, right? And they make the best paint. They have the best like customer relationship management. This is and not $81 billion. I gotta I want to actually look at their their financials. These guys. They sell $23 billion worth of paint every year. Let's look through their most recent presentation. Sales up 3%. Wow. Amazing. Weak consumer confidence, continued inflation, and macroeconomic uncertainty contributing to soft demand. Sales are down 2.6% in North America and Latin America, with big sales growth in Europe, it would seem. Strong financial position. They have $241 million in cash. Total operating leverage is only 2.6%, which is pretty solid. A mystery to me. But they're doing pretty well. So Sherwin-Williams is down only 4% over the last year. Some of our bigger winners are things like Caterpillar, Goldman Sachs, Johnson & Johnson, and NVIDIA. Man, Johnson & Johnson really, they really got lucky by getting rid of Tylenol just in the nick of time. Whoa! They really could have harmed their reputation by continuing to have Tylenol. They're $500 million. That's crazy. Wait. Johnson & Johnson's $500 million. What's that? What does Eli Lilly own that they're a $1 trillion company? Also, are they still a $1 trillion company? They are. They're 1.01 trillion. Presentation. Has it just been like... Huh. What is this? Google Calendar. Archived. There we go. Presentation. Eli Lilly. $54% by key products. Okay. It's wild to me. I don't think I know a single... I don't think I recognize a single thing that these guys have, and they're $1 trillion. Edmonds Club. Amazing. For early Alzheimer's. They got Alzheimer's. Everybody's working on Alzheimer's drugs, though. Total revenue is up 54%. $1 trillion company growing revenue at 54%. What on earth is happening? U.S. sales were $3.6 billion. International sales were $3 billion. And this is just one drug. Can I get like overall? Man, they got a lot of stuff. Okay. Can I get like financial workbook? I don't like that. Awesome. Delete. Um, Lily press release. Yes. 17 billion dollars, 54% revenue growth. What is Mounjaro? Type 2 diabetes and Zipbound. I think I know what both. I think I could probably guess with this guy. Oh yeah, GLP-1s. Okay, so GLP-1 and diabetes. All right, that's why they're doing so well. I mean, it makes sense. That was a fun little tangent. Visa's up 12%. Coke is up 12%. Man, Coke is outperforming Visa. Man, we're going back in time. As for one of these companies, Nike, they're shooting higher a little bit. NKE, they're down 1% today, but they rose quite a bit after they got some investors. They got some new investors. Elliott Hill buys $1 million worth of stock. Elliott Hill, of course, is the CEO of Nike. Nike's seen their stock price fall quite a bit over the last year, from a high of $167 to down to they lost $100 per share. They're not doing great. I think we're gonna look at Nike. Actually, we're gonna go pretty in depth. Nike. We're going to Nike investor relations. I don't want any of this. I just want a presentation or something. Nike. This was December 18th, so less than a month ago. Second quarter revenues were $12 billion, up 1% on a reported basis and flat on a currency neutral basis. Wholesale revenues were $7.5 billion, up 8%, and Nike Direct were down 8%, so flat. Gross margin decreased 300 basis points to 40.6%. That's crushing. And diluted earnings per share was 53 cents. Nike is in the middle innings of our comeback. We are making progress in the areas we prioritize first and remain confident in the actions we are taking to drive the long-term growth and profitability of our brands, said Elliott Hill, president and CEO of Nike. Fiscal 26 continues to be a year of taking action through our Win Now, including realigning our teams, strengthening partner relations, rebalancing our portfolio, and winning on the ground. Revenue is flat. Womp womp. Cash and equivalents were $8.3 billion. What do you mean Nike has $8 billion in cash? How big is this company? Is it 90? They have 10% of their market cap in cash? Hello? Hello? They have 10% of their market cap in cash? What does their debt look like? They have a lot of debt. Total current accrued liabilities? I don't know what that means. Also, I like how they have the actual growth numbers for their cash pile shrank quite a bit. Quite a bit. Crazy. Liabilities and shareholder equity. Current proportion of long-term debt. Accounts payable is $3 billion or $4 billion. accrued liabilities. Not 100% there, but they certainly have enough money to cover their debt. They only have 7 billion in debt in terms of like long-term debt. Operating lease liability is obviously 2.7, but that's long-term stuff anyway. What is accrued liabilities? I wonder what accrued liabilities are. It's China. So footwear, America grew 9%. So the United States, well, North America, United States, Canada, Mexico, grew 9%. Europe, it grew 3%. China fell 17%. And China is kind of a big part of revenue. It's like 10% of revenue. And then total Nike brand. Converse is dying a very quick death, it looks like. Corporate. I didn't know Nike made corporate stuff. Wild stuff. See if I can find out. How is Nike CEO implementing his turnaround strategy? Nike CEO Elliott Hill shows signs of progress in his turnaround strategy, but warns recovery will take time amid rising costs and shifting markets. Nearing a year into his tenure as CEO of Nike, Elliott Hill says his strategy to reverse the company's recent struggles is beginning to show results, but he admits it won't be a quick fix. In an interview with CNBC's Sarah Eisen, Elliott said Nike's on the path to recovery, but cautioned that profitable growth is going to take a while. In a sit-down interview at Nike's headquarters in Beaverton, Oregon, he said, "When we come to work, we think about 3 brands and then multiple sports underneath each brand, and then 190 countries that roll up to our 4 geographies." The turnaround plan focuses on restoring wholesale relationships, restructuring the business around specific sports rather than consumer segments, and reigniting innovation across Nike's portfolio. It's not linear, but it is a portfolio, and ultimately the goal is to have the entire portfolio all working together to drive the revenue and profit that we hope to deliver for all of our investors. Wow. I mean, let's be honest. Nike's seen their stock prices drop a lot. Over the last 5 years, the company has lost the majority of its stock price. Hmm. Un momento. He's back. Back again. Nike's doing a turnaround. I feel like it's kind of a stupid idea for Nike to be like, oh yeah, I feel like it's kind of like a stupid idea for them to be like, oh yeah, we're gonna, and instead of like our core business, which is sports, I suppose, instead we're going to completely reshape our company around like men, women, and kids. And that was the previous CEO's vision, was men, women, and kids instead of sports specific categories. I feel like Nike's whole thing is like sports specific categories. And so to see the new CEO being like, oh yeah, actually we're just gonna return to what we were doing previously, that actually worked, and the reason why our company, went from 23 cents a share to, I don't know, $170 a share. Why don't we return to that instead of this weird, like, incredibly broad categories of things? I don't get it. But yeah, so maybe the CEO's come out and he's bought personally $1 million worth of shares of Nike, which is very cool. So we'll see what happens there. See how that goes. I am somewhat interested in Nike. I want to do real quick. I want to look real quick again at their financials. I just want give me filing. SEC filing, 10Q PDF. Let's take a look. And also, we're going to go to Seeking Alpha. And also, we're going to pull up ROSC AI. Valuation. Let's get the quick valuation metrics. Dropping a little bit of frames, but that's all right. Internet is dying. That's tragic. D- PE. Can you tell how long it's been since I've been here? Financials. Earnings. This is what I'm curious of. Okay. Interesting. So, sales peaked in 2023, technically 2024, 51 billion. They've sold 5 billion less this year. What I'm curious about is cash flow. Stock-based compensation is down. That's neat. They're cutting stock-based comp, which is solid. They are increasing their dividend, which is kind of neat. Free cash flow has halved. Ooh, that's tough. Free cash flow, actually, it looks like this might be like an anomalous year, but it's still down like 25%, which is wild. Yo, Okay, their free cash flow has always been wildly inconsistent. I do not like this. By the way, $3 billion in cash flow, that puts the company trading at like 30 times free cash flow, which honestly, that's pretty good. 30 times free cash flow for Nike? That's honestly it's pretty good. Why is my internet dying? This ain't great. The ship is sinking. Either way, Nike. Crazy. $7 billion in cash is crazy. Yeah, Nike seems like a solid. If they can continue to execute their turnaround plan, I mean, it might be worth taking a look at. Another dog of the Dow, Salesforce. I'll look at their most recent presentation. See why they're falling so far. They are down 23%. We're as low as 32%. So let's take a look. They're flat over the last 5 years, and they've done pretty well over the last since they began. $10 billion in revenue. First of all, how big is this company? This is like a $250 billion. This is a $240 billion. They're already trading at 24 times revenue. They're trading at 100 times free cash flow. Not off to a great start, I think. Q3 revenue. I'm sorry. I'm an idiot. I cannot read. They're targeting 41 billion in total revenue, which 4, 8, 12. That's still 5 times revenue. And it's still 24 times free cash flow. Actually, that's not bad. We'll look a little deeper. It's a good thing editing me can cut all this out of the video. But it will live here forever on this live stream. So if there's anybody here that is watching this live stream right now, just know, we can't all have our best moments all the time. Anyway, subscription and support revenue is $9.7 billion, up 10% year over year, for a total revenue of $10 billion. Agentforce sales is up 8%. Agentforce 360, Slack, and others is up 20%. Pretty solid. $4.2 billion in capital returned. The vast majority of that is in share repurchases. $28 billion repurchased since the inception of total $50 billion authorized. So they're about halfway through their share repurchase plan, which is pretty solid. $2.7 billion quarterly dividend, which is, again, probably not much, I would think, although I need to know how many shares outstanding they have. Full year 2026 guidance summary. So they upped their guidance, which is nice, from 8.5% to 9% to 9 to 10%. So, okay, still growing double digits. Very good, very good. Mark Benioff, and that's it. Agentforce sales. Total subscription revenue. Select acquisitions. MuleSoft. Interesting. So the growth is slowing a little bit, but it's still, double digits. Q3 full year 26. Agentforce and Data 360 annual recurring revenue is $1.4 billion, up 114%. Generative AI and Agentforce. That's insane. I want to know what Agentforce is. It's growing 114% year over year. Well, it's already doing $1.4 billion in revenue. It went from $700 million to $1.4 billion. It went from $620 million to $1.4 billion. R&D is 11% of the budget. Makes sense. Sales and marketing. They spend a lot on marketing. It looks like Salesforce did some layoffs, didn't they? Yes. They laid off about 4,000 people, which is why their general administrative has gone down. So the company cut back on sales and marketing, and they also cut back on staffing, which, listen, I think this is a good sign. Companies, especially companies like this that get to, $250 billion. Now, granted, there's not a lot of them, but companies that get this big, typically they get a lot of get a lot of staff bloat. And so for the company to recognize that and be like, okay, we need to cut back a little bit on advertising, and then we need to cut back on staff as well, is a sign of a really well-run company, because it's a sign of a really well-run company, because the natural existence of a company is not profitability, right? You have to work very hard in order to keep costs down. Otherwise, costs will just completely eat all of your business. And so for them to be able to control costs so well is a good sign. I want to keep looking into CRM. I'm going to keep digging around, see if we can find some stuff. Form 10Q, most recent 10Q. Let's take a look. They also have $9 billion in cash, just like Nike, except they're 10 times the size. No, they're 3. Whoa. What is happening here, guys? Total current liabilities is $21 billion. When earned revenue. Okay, so this is revenue that they've been paid, and they have to provide. Accounts receivable is 5.4. Oh, no. Uh-oh. Uh-oh. I'm still live. Okay, I'm going to keep this right here because OBS is telling me I'm no longer live, but I'm still live. I do not know how we are live, but we are live. Nope, and it's gone. What appears to be the problem? Okay, stay alive. Okay, so I'm still alive here. It's just Twitch that is being stupid. It's very funny because I'm multi-streaming. I use a copy of my Twitch stream in order to stream to YouTube. And my Twitch stream is not live. Why did my Chrome just go away? My whole Chrome went away. That was weird. Wow. My one moment, we are having some slight technical difficulties. I do not know what is happening. But we'll be right back into it, don't worry. We will be right back into it. My 063 come on. YouTube is not receiving enough video. Well, that would make sense. Well, professional streamer, by the way. Again, somehow I'm still live on YouTube. I do not know how. We might just continue without Twitch. And I'll have to fix this off stream because okay, apply. All right. All right, go live. I don't care about this. I don't care about this. Yes. Start streaming. Go live. We might just not worry about it. Okay, well, we're not going to worry about it. So I can't tell you exactly why. Can't tell you exactly how I'm live, but I am. Okay. We're back. Officially. For now. Wow. That was annoying. But we're good. I wonder if all of that went away. Now, let me check. Videos. Streaming. Oh, it does MKV. Yes, let's go. Okay, fantastic. Thank you. Man, OBS is maybe the greatest thing ever created. Okay. That was the first part of stream. Now we're in the second part of stream. Wildly Salesforce, solid stuff is happening here. I have no internet. I have no internet. This is so tough, bro. Or at least I don't have enough internet. Okay, never mind. We have enough internet. Everything was breaking, but now we're good. Okay. Ignoring all of that. Salesforce, solid company, I think. Let's keep reading. Okay. Salesforce is a global leader in customer relationship management. AI across systems, apps, and devices. Wow. The company introduced Agentforce, a new layer of the trusted Salesforce platform that enables companies to build and deploy AI agents that can respond to inputs, make decisions, and take action autonomously across business functions. Agentforce includes a suite of customizable agents for use across sales, service, marketing, and commerce. Since its founding in 1999, the company has pioneered innovations in cloud, mobile, social analytics, and AI, enabling companies of every size and industry to transform their business into the digital-first world. Okay. So Agentforce is so they're competing directly with UiPath, who can't decide if they're the greatest company of all time or literally the worst. Very funny. Anyway. We're good. We good. Path slips pre-market as S&P Midcap 400 debut and CEO share sale filing hit focus. The CEO's selling shares. I wonder why. Yo, that is tough. It's all the CEO. Yo. 1.5, 2.2, 1.5, 700, 700, 700, 700, 1.6, 8, 8, 8. Yo, he is non-stop selling. Nobody is buying. Everybody is selling. And they're all selling right now. Man. What's my average price for this company? That is insane. Nobody wants to own UiPath. I'm up 20% on my position. Wow. It's down 4.5% today. My average price is 13.18. I mean, it's good. That's kind of a little scary, right? So the incumbent, which is Salesforce, is just like doing the exact same thing that UiPath is doing. Isn't Let's find out. Let's see if there's a meaningful difference. Oh, my internet's dying again. I love this. I love the description of what these two things do. Agentforce is an AI platform built by Salesforce that focuses on automating tasks and providing real-time insights with Salesforce customer relationship management software. It is designed to manage customer interactions, sales process, and service operations effectively. Meanwhile, UiPath is a leading robotic process automation platform that uses to automate repetitive, rule-based tasks across various applications and systems. So Agentforce is a thing that operates inside of CRM to automate stuff inside of CRM. Meanwhile, UiPath works across the entirety of the computer. Okay, I mean, fair enough. Figma versus UiPath. I feel like Figma is not... Of all the companies that I would think would benefit from AI, I feel like Figma would not. You know? It just doesn't seem like a... Just doesn't seem right. As for our last dog of the Dow, we have Procter and Gamble. We have the most recent annual report. Let's take a look at what their company is doing to fall. P&G, Procter and Gamble, 1 year performance. They're down 15%. Wow, they are not doing great. Meanwhile, their dividend yield is up to 3%. Not very high for. I would imagine that Procter and Gamble would have a much higher dividend yield. Anyway, Procter & Gamble, let's take a look. 2025 annual report. Net sales were $84.3 billion. They only made $300 million more than last year. Not great. Organic sales growth was 2%. 4% on the EPS. So growth has stalled to basically nothing. Organic sales growth. Organic sales for the fiscal year grew 2%. Core earnings per share grew 4%. On a currency-neutral basis, core earnings were also up 4%. Adjusted cash flow productivity was 87%. What that means, I have no idea. Let's find out, though. The last quarter was our 39th consecutive quarter of top-line growth. Okay, that's less than 4 years, which, you know what? Good for them. It's only 2%, but it's consistent 2%. 9 of our 10 product categories grew organic sales for the year. Must not have been very much. On the bottom line, we delivered 4% core earnings per share growth despite the higher costs from commodities and tariffs we faced throughout the year. We increased our dividend by 5% and returned over $16 billion of cash to owners through nearly $10 billion in dividends and $6.5 billion in share repurchases, consistent with our guidance at the start of the year. This is the 69th annual dividend increase. Nice! 69 years. And the 130, this is so impressive. Procter & Gamble, ladies and gentlemen, this is our 69th consecutive annual dividend increase and our 135th consecutive year Procter & Gamble has paid a dividend. Just impressive all around. Just impressive all around. And what do? They just sell commodities. That's about it. Sometimes the boring businesses are the best ones. They had to cut their dividend 135 years ago. 135 years ago was like 1890. When was Procter & Gamble founded? $1837. Procter & Gamble started paying dividends shortly after its incorporation in 1890, marking the beginning of over 135 consecutive years of payments and dividend increases, with recent payouts around $1. That's crazy. 135 years. My dog's been paying dividends longer than they went from 259 to 408. 69 years. Nice. How far back? They go all the way back to 1989 when they were paying out 5 cents per share. What an impressive history. They're just built different, I think. 69 years of dividend increases. Now, obviously, past performance is not indicative of future performance. However, if your performance is long enough, they're a consumer goods company focused on providing trusted branded products of superior quality, performance, and values. I'm somewhat curious. Give me one moment. My internet is dying. I don't think I can stream. Either way, yeah, nice. Okay, but yeah, Procter and Gamble. Oh yeah, I was gonna check live. Okay, so it's still all one continuous sort of deal. Can I hang on? We're taking another momentary break. And by momentary break, I mean not that momentary. I just want to check something on YouTube real quick. Okay. I don't think I can continue to stream. My internet is so dead. But we're gonna press on. Procter and Gamble. If you don't know anything about Procter and Gamble, they have a lot of very famous brands. They have a lot of very famous brands. Align, Always, Ampere, Ariel, Bounce, Bounty, Aussie. You've probably bought many of their products in the past. Braun, Cascade, Charmin. And, yeah, they've been around for a very long time, and they're continuing to grow revenue, pay great dividends, grow those dividends. For 69 years, they've been growing their dividend. I don't know what is happening. $10,000 kilobytes a second. It's pulling. I reset my internet connection. I think we're fine now. Anyway, Procter and Gamble, probably one of the top tier, I would say, pretty top tier in terms of the dogs of the Dow. So and that's generally, like I said, that's what we were looking at, was the dogs of the Dow. These are the companies that have sort of performed the worst over the last year. United Healthcare, obviously. The United Healthcare is always kind of a tough company to talk about. Obviously, because of the last year. But the big whole fraud thing, and it just wasn't great. And plus, I don't really understand it, and so I try not to invest or talk about companies that I don't really understand all that well. But other companies, much more easily understandable ones like Salesforce, Nike, and Procter and Gamble. Nike especially, I think out of all of these guys, Nike has seen such a dramatic fall over the last couple of years, and it looks like they are righting the ship. It's down 63%. They've lost $100 per share, and basically they cleaned house and are starting to turn things around, which I think generally is solid. Are they worth investing in? I do not know. I'm not 100% sure. They have very strong balance sheet. They have very little debt. And their turnaround plan, I guess, is going pretty nicely, at least according to the CEO. Their revenue is growing. One of the big problems with Nike moving forward is definitely going to be the China problem. So we were looking at Nike a little bit earlier. And they have somewhat of this looming, like, a sort of Damocles, if you will. And that is China. So this is the disaggregation of revenues. So North America is growing genuinely. They're growing quite quickly. revenue in North America was up 8%. Um, can I get the full disaggregation of revenue and the growth? Yeah, Greater China revenues decreased 16%. Hey, here's the. Yeah, okay, here we go. This is exactly what I was looking for. So, if we go across their sort of major regions, and this is something that the CEO was actually talking about, was they sort of have their 4 major regions: North America, Europe, Greater China, and the rest of Asia, I think. Although we'll take a look, we'll find out. Or no, their other segment is just like the Nike brand thing. So North America, we see 9% revenue growth, right? So 5.2 up to 5.6 over the last year, genuinely pretty good. Wholesale customers is up 24%, and Nike Direct is not doing great. And that has also led to the direct sales obviously would be higher margin, but wholesale distributors going to be a bit lower margin, but more consistent sales growth. And so margin is of course going to take a hit in North America, but North America obviously is also one of the largest business segment, $5.6 billion. And then if we go over to Europe, it's about a third the size at 2 or half the size at 3.3 billion. But importantly, Europe, Middle East, and Africa is still growing 3%. So again, that is being led primarily by apparel, not so much equipment or footwear, which is where the other guys are getting their growth from. And not only is wholesale, but also direct. So margins are not taking that big of a hit. But yeah, they sort of have a China problem. Revenue from Nike in Greater China, footwear is down 21%. Apparel's down 6%, and equipment's down 25%. I don't know that they have a very good explanation as to why either, which is not great. But yeah, that's seen total revenue down 17%, not only in wholesale, but also direct. Gross margin hasn't fallen that much though. I wish I could get 13% on a constant currency neutral basis. And then Asia, yeah, the rest of Asia and Latin America. They kind of have an Asia problem, it would seem, down 4%. Although this is only, $1.6 billion worth of revenue, so just a little over 10%. Give me one moment. Wow. But yeah, one of the things, um, one of the things that I think, Nike certainly has to overcome is this China problem. Nike really does have a big China problem. They're seeing China and Asia in general because they're seeing revenue fall like 20% in those regions, and it's not being made up for revenue growth in North America. Yeah, revenue growth is not being made up for in North America or in Europe, especially not Europe. Europe is basically flat year over year. So, of all the dogs of the Dow, I think Nike is probably the most interesting. Salesforce has some interesting things about it. Procter and Gamble is kind of probably like the underdog of them all. They've seen revenue pretty much flat over the last couple of years, but they pay a good dividend, and they're just like a solid company. They have great consumer brands. Procter and Gamble is the exact same thing that I would say about Kenvue, and Kenvue just isn't a good company to invest in. They have great consumer brands, but those consumer brands are not growing. And so the only thing that you can really expect out of them is like low single-digit sales growth, and for them to return capital to shareholders, and that's basically it. And so I would say certainly of Procter and Gamble, that one of their big problems is they just don't have revenue growth. They just don't have good, products, and so they're pretty much entirely reliant on acquisitions of products that are growing quite quickly in order to continue to grow revenue. Honeywell is a very strange company because they do all sorts of stuff. They just do. They just do everything. I don't know that they do anything like incredibly well. But they just do automation, energy transition, future of aviation, the forge, cybersecurity. Man, they just do everything. The only thing that I think a lot of people know Honeywell for is their thermostats. Investors. Let's take a look. Honeywell at a glance. Let's see if we can figure out what this company does. Honeywell is delivering the future of automation, air travel, and energy with our industry-leading software-enabled solutions. We create shareholder value through profitable growth and strategic high-return capital deployment. $38 billion in sales in 2024, 13% free cash flow margin. They've been increasing their dividend for 15 years. 10-year return is 192% share owner return. Very cool. They employ 100,000 people. So aerospace is the vast majority of revenue, 40%. Industrial automation is 26%, and building automation is 17%. 10% EPS growth since 2004. That's genuinely just great. That's very hard to do. 10% compound EPS growth over the last 21 years. They did get rid of Solstice. This is the company that spun off Solstice Materials, which is their chip unit. And we were looking at Solstice a little while ago, and that seemed to be not the most compelling company in the world, but it was at least interesting. $4 billion in sales. This is just Solstice. Portfolio transformation. Sundyne. They're blowing their company up. What do you mean? Creation of 3 public companies, an important step to portfolio optimization? What do you mean? Oh yeah, they're blowing their company up. Honeywell Automation, Aerospace, and Advanced Materials, and then Solstice. That's so interesting. This is you know what's gonna happen? I bet 3M's gonna blow their company up soon. They're gonna be the next ones to sort of slake off. GE did this. GE did this at the beginning of the year. They separated themselves into 3 separate companies powered by AI. Amazing. It's powered by AI, guys. Yeah. So Honeywell does all sorts of stuff. This is so crazy. The amount of stuff that they do. Utilities, energy storage, the pharmaceutical industry, battery automation, pipelines, industrial plants, refineries, and petrochemicals. I mean, they have a hand in literally everything. I am somewhat interested. ROIC is in almost 20% over the last, just like consistently strong return on invested capital. It's interesting to see a company that is like doing pretty well, it looks like, just decide to. They haven't really gone anywhere though, right? Since 2021, they've been mostly flat. But yeah, it is somewhat interesting to see a company like this, that's relatively strong. I wonder if their revenue just isn't growing. They've done a lot of buybacks, a few $1 billion worth of buybacks, pretty solid. Operating income, I forgot these guys were just like, oh, okay, yeah, we're just gonna split our company into 3 separate companies. It's like, well, all right, that's what you want to do. Solstice is already a public company, but those are the major dogs of the Dow. These are the worst performing companies over the last year. I think there's a lot of opportunity here, especially in Nike. I would put my bet on Nike. That of all of the dogs of the Dow, the worst performing companies over the last year, United Healthcare probably has some rebound to do, although they have a whole mess to sort out. Salesforce also looks kind of nice. They're growing revenue quite quickly. Agentforce is a compelling and interesting product. I would definitely want to look into that a little bit more. Nike, the turnaround plan is good. They have a new CEO. They cleaned house. They're refocusing on their core strengths that made them a good company. And so I wouldn't be surprised if Nike is the big turnaround story of the year. Procter & Gamble, not a great company to invest in for like capital growth, but it does have a solid dividend yield. They've been growing their dividend every year for 69 years. And so it's just kind of like a strong, stable part of any portfolio. I would expect to see Procter & Gamble recover a little bit in this next year. Maybe not a ton. You're probably not going to get a ton of capital appreciation, but you will get a nice dividend. It's sort of the same argument I made for buying bonds over the last couple of years. Bonds eventually, when rates start to get cut, the price of bonds will probably go up, hopefully, ideally. And so as the price of those bonds continue to grow up, you're literally just getting paid to sit around and wait. And so, it could be good. Honeywell has decided to completely obliterate their company and split themselves into 3 separate companies. And so it is very hard to do any sort of like fundamental analysis because they've already spun off one part of their company and they're spinning off, another 2 parts of their company. So it's very hard to do any sort of fundamental analysis on Honeywell. Home Depot, obviously a staple of the industry. They've done not great over the last couple of years, but or over the last year, they've seen sales sort of decline. They've seen, for all sorts of reasons, inflation just not great in terms of storms. They talked about a lot. One of their major revenue growers is like major storms, and they just didn't have any, and so they just didn't have that storm season that they usually get. So they saw revenue decrease a little bit off of that. Sherwin-Williams sells like $25 billion worth of paint every year. Sherwin-Williams definitely for me is a black box of a company. Yeah, I don't know. I should do a tier list of this. What I think what I think would be the best performing dogs of the Dow. But yeah, I would say Nike, 100%. I'm surprised Google isn't in. Google's like a fundamental part of. Well, then again, I can understand why Google's not here. That's the dogs of the Dow. I kind of want to look at Mercado Libre. What's this? Melly. Free Melly. Mercado Libre. 20%. PE ratio is still 50. Yikes. Yikers. $100 billion market cap. Yeah, sure. Let's talk about Mercado Libre for a minute. Mercado Libre, a company that has been hyped up for a very long time. They saw tremendous growth in 2020, 2021. They are basically, now listen, they're basically the Amazon of like South America or South and Central America. I hate using that terminology, but it's the closest thing because listen, this company does so much stuff, and we're gonna get into it. The amount of stuff that this company does is like unbelievable. Mercado Libre, who are we? Let's take a look at who they are. Take a look at the letter to shareholders and earnings presentation. We'll start with the earnings presentation for Mercado Libre. Operational and financial highlights. They did $16.5 billion in gross merchandise volume, up 30% year over year. Total TPV, I forget what this is 71 billion. And you see a lot of this, you see a lot of stuff. Credit portfolio, $11 billion, and revenues is $7.4 billion in US dollars, which is up 40% year over year, by the way. 40% is something, that's pretty special, I think. Adjusted free cash flow is $200 million, which this, by the way, is a $100 billion company. So they're trading at, 5,000 times free cash flow. Not great. Not off to a great start. But unique active buyers growth continues another 26%. They are growing and growing. Year over year, they went from $60.8 billion to almost 77 million active buyers on their platform. Marketplace, gross merchandise volume and items sold accelerated in Brazil and Mexico. With consolidated items sold at its highest since Q1 of 21. That's very good. Marketplace highlights. Same and next day shipment. Literally Amazon, by the way. 28% up year over year. Items sold per unique buyer is 11%. Fintech. They're also a fintech company. If you don't know, they're also a fintech company. They have the marketplace, but they also have this sort of like banking stuff. Monthly active users grew 29% year over year from 56 to 72 million people. Fintech services highlight assets under management. They have $15 billion in assets under management. It's growing over almost 100% per year, which is just, insanity. Credit portfolio, consumer, credit card, merchant, asset back. They have tons of, they're in basically every industry. They're basically SoFi mixed with Amazon. Acquiring highlights. Slower growth in Argentina. Financial metrics. Commerce net revenues is 38%. So growth has slowed down. Maybe this is why So it's 121% down to 40%. Meanwhile, revenue growth in the fintechs is, FX neutral. Yeah. So this is quite possibly why. This is quite possibly why the stock has fallen the way that it has, because you saw sort of commerce net revenues. It was growing at 121%. In quarter 3 of 2024, which is very impressive, but that growth has slowed all the way down to 38% year over year. So growth has slowed down dramatically. It has fallen to about a third of what it was. But yeah, Mercado Libre doing very well. Just not as well as they were. Operating margin still remains around 10%. Net income not as good. Adjusted free cash flow. Adjusted free cash flow is up. What is this chart? What is happening here? Adjusted free cash flow of $206 million. This is after capex of 357 and investment of 1.7 billion and the growth of the credit portfolio. Leverage remains very low as well. So Mercado Pago, which is their, I think that this is the fintech side of their business. They still don't have a tremendous amount of debt, and they have a lot of cash. Available cash and investments versus net debt is 4.6 billion. Yeah. So they're keeping a lot of cash on the books. Their total debt is 9.8 billion, but they have 5.2 billion in cash, which is just great. And this is a total overview of everything. So yeah, they do a lot. We're pleased to report another strong quarter demonstrating that our investments are delivering results across our ecosystem, from widening access to credit and payments to strengthening our marketplace value proposition and reducing the friction of shopping online. Our investments underpin the rapid growth of our key operating metrics. Our net revenue and financial income grew 40% year over year, the 27th consecutive quarter of growth above 30% year over year. We were just looking at Procter & Gamble, and they were like, yeah, we've had 39 months of consistent revenue growth. Meanwhile, Mercado Libre is like, yeah, this is our 27th quarter of revenue growth above 30%. It's like, all right. That's impressive. We continue to make strong progress in leading the shift of offline retail to e-commerce in our region. E-commerce penetration has the potential to double in the coming years, which implies the e-commerce market more than doubling. Our ambition is always to grow ahead of the market. Offering more free shipping is a key pillar of our strategy to capture more long-term growth opportunity. Indeed. Yeah. I don't know if I'm gonna be able to continue streaming. I just think there's too much happening. But that is alright, I suppose. Intel's still up 7%. Beyond Meat's up 7%. Oh well. It was fun while it lasted. But goodbye for now, I suppose.